Oh shit. What is up, YouTube? Oh my god. Intro. Oh my gosh. Alright. So today I'm going to be talking about how to trade fair value gap conditions, and pretty much what this is, it's how to target and use high time frame fair value gaps to make some money. Alright, so let's start it off. Specifically, if you're watching this video, you should already know what a fair value gap is. If you don't, look up a video, but it's irrelevant. Alright, so first step when trading fair value gap conditions, you want to figure out your draw on liquidity. So, for example, say we're in an uptrend, boom, 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 and we have, it's like a data high right here, right? Boom. Whatever our draw on liquidity is, there's videos on that. You want to mark out the draw on liquidity that you're targeting, same way as if it were bearish. Alright, and then from there, once you have your draw, you're now going to be looking for a, oh, I didn't write it in here, 2A. You're going to be looking for a 5-minute or 15-minute fair value gap. And if your draw on liquidity is higher, you want a bullish 5 or 15-minute. And if your draw on liquidity is lower, you want a bearish 5 or 15-minute. Dang, pretty simple stuff. Alright, let's mark this as 2B for anyone that's screenshotting this. Alright, so now from there, you want to figure out if it's continuation, and I'm going to get into examples for this, but for now, you're going to go, oh, are we continuing up, going to our draw on liquidity, or are we rebalancing a fair value gap, right? Alright, I'll show examples of that, and then from there, entry model. This is just the basic framework of how to trade these conditions. Alright, now I'm going to go to the example. Alright, whoa, how'd this get here? Alright, perfect. So, we have we're bullish, right? So you see we're bullish, and then here, we open up a 5 or 15. It could be either. I prefer the higher time frame ones because they hold more power, but you're going to want to look for a retrace into this, and then what? You're going to be looking for your entry model. So I trade inversion fair value gaps. So right here you can see my entry would have been right here, and this is just an example, and my draw on liquidity is higher. Boom. So there you can see it. We have the bullish. We're bullish. We're going towards a bullish draw. It's pretty simple. We're just looking for a retrace, and an example, if you were to target this, I will get into that after I show the bearish example. Oh my god, how did that get there? Alright, so we're bearish here. You see, oh, I didn't mark this out as 5/15-minute. Okay, bang. So here, we would have opened up a 5 or 15-minute bearish fair value gap. And then you would wait for a retrace into this, and then your entry model, which would send price to your draw on liquidity. I did not cover, I'll cover break even and take B. Alright, so for break even and take profit, so the reason you have your stop loss at this swing point right here in the high time frame fair value gap is because that is now a protected swing point. Why? Because you just took liquidity from this fair value gap and now you're delivering lower. There's no reason for price to come back and revisit your stop loss. Your break even or take profit. Now this really depends on the size of your RR or what you are trying to risk. Like if you're going for low hanging fruit, sure, you would go for something more internal, because the external draw, it's less likely to get hit. Say there's an SMT or something happens where we take out this swing point and price just decides to fly back up and then rebalance again and come down. You'll just get stopped out, break even. That's why we go break even or full TP at the most recent swing point. I did not cover this one, but yeah, pretty much same idea here. Once price retraces into this bullish fair value gap, it's going to be a now protected swing point, so your stop loss would be here. And then RR, really just you want to go for more than a 1-to-1. So say you get filled up here and you're not getting a 1-to-1 at this swing point, then you could go for this being the break even. It really just depends where your entry model or where you get filled, where your inversion or where you get filled is at compared to where your break even / draw on liquidity would be. All right, and then I'm gonna show some examples. Bang, bang, bang. All right, so this is Tuesday, yesterday. What do we see, right? See, we're delivering higher, right? Disrespecting bearish, respecting bullish, right? So where are my draws? My draws are higher. All right, so then we go into. All right, market open. What am I looking for, right? My draws are higher, right? We take out these exterior draws, right? And some might say, oh, this is now high resistance liquidity. Well, if this is high resistance liquidity, then our 5-minute gap should get disrespected then, right? Because if this really would have started the sell model, then we wouldn't have respected this gap, as well as there is a higher draw. So the objective has not been hit, right? But that's not the premise of this video. The premise of this video is how can you use these fair value gap conditions. Oh, perfect. So right here, we tap into our high time frame gap. Let me get rid of this so you can see it better. We tap into our higher time frame gap, right? And what do? We get our entry model right here. And what do we target? Pretty simple stuff. So now we have our stop loss at this protected low. Why? Why is it protected? Because we just respected this high time frame bullish gap. And what are we targeting? We're targeting draws. You go for a 1-to-1. You go break even right here. You could target this, right? This hit within, what is that? Like 3-4 candles. And that is a basic situation. You're pretty much using these fair value gaps as reasoning behind where price is going. The way we understand how price works, right? We go from like this. We go from fair value gaps, which would be internal range liquidity, to external range liquidity. And it's pretty much the same premises, but on a more fractal scale rather than having it align with like 4-hour, 1 hour, but you're just using 15 and 5-minute. Because if you're bullish, then bullish gaps should hold to your bullish draw. And if you're bearish gaps should hold to your bearish draw. I'm now going to show a bearish example. Bang! Welcome back. I found my bearish example. All right, so what do we see here? We have this conditional fair value gap, right? So if we are bullish, we are not delivering from anything right here. So we are generating low resistance liquidity, right? So what I would want to see if I was bullish, I would want to see this last gap hold, or I'd want to see this gap hold, right? And so now what is my condition? If we tap this gap and see a bearish reaction, I could assume that we're coming back down to revisit these stacked lows, right? So I'm just going to play it out, and you will see exactly what I'm talking about. So we're just generating liquidity, right? Low resistance liquidity. Boom, we tap into it. What time frame fair value gaps do I have? I go from the 2-minute, right? Okay, I have a 2-minute, 3-minute, 4-minute, 5-minute. No, so my highest time frame would be the 3-minute, right? So then I'm looking, right? I'm taking the inversion out of this and putting my stop loss at this now protected swing point. And where do I break even? What am I targeting? You could break even here. You could target. You could even target a 1-to-1 right here. You could target all of this generated liquidity, especially you could target down to this low because it's not delivering from anything. We didn't sweep this liquidity. And yep. Yeah, I would have hit by the tick or a little bit. But I wouldn't have gone for a 5 RR. I would have targeted low-hanging fruit like here, or I would have targeted an unmitigated gap like this, hitting around a 3 RR. But the premise is more about the condition. You pair the condition. Why do we make this bearish fair value gap the condition? Because it is the last thing that would stop price from going higher, and it would stop it from being bullish. I also have a very important note. That pretty much covers how to trade conditional fair value gaps. Today in the market was pretty chopped. I don't know, but holy. Just remember, I'm gonna cover it again. Are we delivering from internal or external? Which would be, are we delivering from a fair value gap towards a drawn liquidity? So you'd be looking for a continuation, or did we just sweep sell side or buy side, and are we rebalancing an inefficiency or a high time frame gap? I hope this helps. Let's make some bread this week. Let's all get our money up. Let's all get 50K payouts. Oh, I need my exit song. Not a way to make it move, I be floating. Alright, that's it for today.